Learn at your own pace and come back to sections you want to revisit. With that said, let's start the timer and explain the difference between ETFs and mutual funds. Look, you want to buy ETFs, not mutual funds. Spoiler alert. What? No suspense at the end? No big reveal? No build-up after 4 commercial breaks? Look, I only got 5 minutes to explain, so I might as well cut to the chase. It's because for basket investing, you want to own ETFs. And in some specialty cases, maybe mutual funds. So let's dive into the details and explain why. The first mutual fund was created back in 1774 by the Dutch to finance explorers, and I explained that in our video on stock investing. When a bunch of investors pool their money to invest, the generic term is a fund. And the first funds were not open to any buyers, but exclusive to a small group of investors. Look, it would take 150 years for 1924 when Massachusetts Investors Trust offered an open-end way of buying shares of their fund, and this fund contained various stocks picked by one of their portfolio managers. It was the first mutual fund with an open-end capitalization. That meant allowing for the continuous issue and redemption of shares by the investment company. And after just 1 year, that fund grew almost 500% in assets and eventually became known as MFS Investments. Still in business today, with around $528 billion in assets. So, why were these funds so popular that assets grew so rapidly? The answer is supply and demand. A subject I covered in another video I cleverly titled, Supply and Demand. So, demand was so great for ordinary investors to invest because they could easily participate in the stock market without having to figure out which stocks to buy or sell. Some professionals dealt with the daily activities of investing, and the shareholders didn't worry about the business of stock investing. Buying a basket also meant spreading out that risk over many names versus maybe just buying a few select positions based on limited investing resources. So diversification was really born for the average investor. In the early days, mutual fund sales commissions ranged from 5 to 8% or more to purchase. Plus, they had high ongoing internal fees to manage the fund every year. Look, over time, with this digital innovation and competition, those commissions are almost non-existent at all today. And high internal fees have been diminishing each year. In our extended portion, I'm going to explain how innovators like Charles Schwab and John Bogle changed an industry, along with companies like Morningstar, or for that matter, the entire retirement industry. Stick around for this added knowledge so you can become the best investor possible. Then, if mutual funds were created, first, why were ETFs created and how are they different? Good question. Glad you asked. ETFs are the acronym for Exchange Traded Funds. And in my opinion, they are a superior vehicle for most investors looking for diversity. Here are some reasons I think they are better than mutual funds. First, ETFs can be traded throughout the day, and mutual funds are not redeemable until at the end of the trading day. So with funds, you don't have any idea of what price you're going to get per share to buy or sell until after the market is closed. Why? Because ETFs calculate their fractional share price constantly through the day, and they could constantly buy or sell to meet that demand for their basket. So, liquidity winner is ETFs. Mutual funds must keep cash available for possibility of redemptions, whereas an ETF can get close to fully invested. So cash efficiency, winner is ETFs. As a professional, I can buy or sell a large position in ETFs in just a few seconds at a very fair price. So, winner for transaction efficiency, ETFs. Sales costs and fees. Both choices have internal fees to pay for professionals and other aspects of servicing the fund. Costs are expensed as an expense ratio. And here's an example of a few expense ratios where you'll see them. In my observation, ETFs will consistently have lower fees and overall cost to buy and maintain than a mutual fund of somewhat similar investment portfolio. ETFs don't come with upfront or back-end sales charges, but some mutual funds are still sold that way. So, winner for low cost and fees, ETFs. Taxation. Well, this is very important, and many people skip over this critical detractor from mutual funds. Tax-efficient winner goes to ETFs. For right now, let's stop the clock as my commitment was to briefly explain in 5 minutes or less, and now the winner has been crowned, and it's ETFs. So stick around for the extended version, and I'll also explain technology and financial innovation, and how it's allowing ordinary investors to create their own diversified baskets for very low cost with no sales charges. There are some examples when I think a mutual fund might be better than an ETF, and I will cover that and much more in my extended version. But before you invest in more of the video, take a brief moment now to hit the like and subscribe buttons so I continue to make videos just like this for you and many others. It's the easiest thing you could do with the highest return on investment. You should tell us what you liked or how we can improve, because the goal is to empower you with knowledge so you can be the best investor possible. Share with your friends and family that you would like to see also become financially successful. I'm Ian Goldie, and this has been Finance in 5, ETFs versus Mutual Funds.